Okay, let's dive in. So, Warren Buffett's annual letter, it's basically required reading for anyone interested in business, right? Investors everywhere pore over it.
Oh, absolutely. It's like a master class delivered once a year.
hmm
And, there's this one fact from this year's letter that just, wow.
Which one? The tax number?
Yeah. Berkshire Hathaway paid, get this, $26.8 billion in corporate income tax to the U.S. government in 2024.
Billion. That single number just kind of frames the sheer scale we're dealing with here, doesn't it?
It really does. It shows they're not just some big company. They're a massive economic force.
Yeah.
And this letter gives us that unique peek behind the curtain.
Exactly. So what better way to get a handle on this giant than going straight to the source? We're doing a deep dive into that brand new letter to shareholders.
Consider this your curated tour. We'll pull out the key stuff.
Right. It's packed with performance details, their philosophy, the outlook, the works.
And, the way he frames it is interesting, too. He writes it like you, the reader, are the CEO, and he's just a passive shareholder. It changes the whole tone.
Yeah, it's a unique perspective. So our mission here, pull out the biggest insights, the surprising bits, the real lessons, save you wading through everything yourself.
But still get the core value. Ready to jump in.
Let's do it. Where should we start? Maybe with something you don't often hear from CEOs.
Good idea. Let's talk about mistakes, actually admitting them.
Right. Buffett is pretty upfront about it. He talks about errors in, how they've invested in capital, both stocks and buying whole companies.
And even personnel decisions. Hiring choices that, well, didn't quite work out.
Yeah, exactly.
And it's not just admitting them, it's the emphasis on fixing them fast. He brings that Charlie Munger line about thumb sucking.
Yeah. Don't just sit there pondering the problem.
Right. Munger's point was problems don't get better with age. They usually fester. You have to act.
So refreshing, that kind of candor. You just don't see it that often.
Buffett points that out himself, says he's used mistake or error 16 times in the last 5 years in these letters. How many other Fortune 500 CEOs are doing that?
Probably 0.
Yeah.
Or close to it. He did give a shout out to Amazon's 2021 letter, though.
True, as an exception. But he talks about this taboo in boardrooms and on analyst calls. Like admitting a mistake is the worst thing you can do.
Which he says makes him nervous. Understandably, if you can't admit you messed up, how do you fix it?
Exactly. And he makes a point of saying Greg Abel, the designated successor CEO, shares this commitment to being straight with people.
That's important for the future, for sure. That culture continuing.
Definitely. Okay, so shifting gears a bit. The letter also highlights some maybe unsung heroes behind Berkshire's success.
Like Pete Leigel.
Precisely. Pete Leigel and Forest River. Most shareholders probably haven't even heard of him.
But Buffett says he's added billions to their wealth. So Forest River, that's the RV company.
That's the one. Acquired back in 2005. And the story of how is pretty great. Pete owned the whole thing. Apparently, he just decided he wanted to sell specifically to Berkshire and just wrote them a letter.
Simple as that.
Pretty much. And the negotiation, even better. Buffett talks about Pete's, no-nonsense style, especially on his own pay.
Oh, yeah, I remember reading that. He didn't want some huge golden parachute.
No. He basically looked at what Buffett was paid, which wasn't astronomical, and said, I don't want to make more than you. Asked for $100,000 a year tied to Buffett's salary, plus a bonus if they beat their existing earnings.
Buffett's reaction was priceless. After I picked myself off the floor.
Yeah, it just shows how unusual that kind of thinking is. And then Pete stays on to run the company?
And just crushed it, right? Shot the lights out, I think was the phrase.
Yeah.
Outperformed everyone for nearly 2 decades.
It really underscores the value of having those owner-managers. People who think like owners because, well, maybe not literally anymore, but they have that deep commitment. It's rare.
That story really sticks with you. Okay, so Pete's a great example of management. Let's zoom out a bit. What other big factors does Buffett point to for their success?
Well, he talks about the cumulative impact of just making good decisions over time. Winning decisions, he calls them.
Like what specifically?
He mentions Geico's turnaround, gives Todd Combs credit there, Ajit Jain's huge impact on the insurance side, and of course, the partnership with Charlie Munger.
Yeah.
Decades of that.
Right, those foundational pillars. And then there's that really provocative point he makes about hiring CEOs for their subsidiaries.
Oh, yeah. The education thing.
He says he never looks at where they went to school. Never.
Which really flies in the face of conventional wisdom, doesn't it?
Yep.
He admits lots of great managers do come from top schools, but argues that a lot of that core business talent is just innate.
Nature swamping nurture, as he puts it.
Exactly, and he backs it up with stories. There's Pete Leigel, again, Probably no fancy degree there.
And Ben Rosner, the guy who ran a business for them but only went to 6th grade, Buffett called him a retailing genius.
Incredible. And he gives a nod to Bill Gates, too, dropping out of Harvard to build Microsoft. Recommends his book, Source Code.
So the takeaway is look for the raw talent, the drive, the practical smarts, not just the diploma.
Pretty much. It's about ability and applying it.
All right, so let's get into the numbers a bit. How did Berkshire actually do in 2024?
Overall, better than Buffett himself expected, actually. Which is interesting because he notes that over half their operating businesses saw earnings decline.
So how did the overall picture look good then?
A big piece was investment income. Those higher yields on Treasury bills really kicked in. They hold a lot more T-bills now.
Makes sense. And the insurance operations. I heard Geico had a good year.
A great year, according to Buffett. He calls the improvement spectacular. Credits Todd Combs again for reshaping Geico over the last 5 years, modernizing it, making it more efficient.
But he adds a note of caution, right? Like the job is not totally done yet.
Yeah, transformation's still ongoing. He also mentions property casualty insurance pricing got stronger.
Is that linked to, like, storms and things?
Potentially. He mentions more damage from convective storms, even touches on climate change as maybe playing a role. But he's quick to add that 2024 didn't have a monster catastrophe.
But one is bound to happen eventually.
Always. He says a huge loss is inevitable, could happen anytime. That's just the nature of insurance. You price for it, but you never know when it hits.
What about the other big pieces? BNSF, Railroad, and the energy company?
Improved earnings there, too, in aggregate. Though he thinks both BNSF and Berkshire Hathaway Energy still have room to improve quite a bit.
And didn't they increase their stake in the energy business?
Yep, bought the rest of it, own 100% now, as of late last year.
Okay, now Buffett always hammers on one particular number for performance.
Operating earnings.
Okay.
Always operating earnings. $47.4 billion for 2024.
And he specifically says not to focus on the GAAP earnings.
Right. He calls GAAP earnings flawed for analyzing Berkshire because they include the swings in their stock portfolio value.
Yeah.
Too volatile, doesn't reflect the core business performance month to month or quarter to quarter.
And he takes a shot at EBITDA too, doesn't he?
Oh, yeah. Calls it a flawed favorite of Wall Street because it ignores real costs like capital spending and debt payments. Berkshire doesn't use it.
Instead, he breaks down those operating earnings, shows you where the money's coming from.
Exactly. Insurance, both underwriting and the investment income from float, is a huge chunk. Then BNSF, the energy business, then all the other controlled companies, and the share of earnings from companies they don't control, like Apple.
That breakdown is really helpful. Okay, let's pivot to something truly mind-boggling. The tax story.
It really puts things in perspective, doesn't it? He starts by reminding everyone that buying the original Berkshire textile mill in 1965 was a mistake.
A mistake that hobbled them for decades. And the proof?
In 1965, Berkshire paid zero income tax. Nothing. Because it wasn't making money.
Wow. Fast forward to 2024.
A record $26.8 billion paid to the U.S. Treasury. And get this, he says, that's about 5% of all corporate income tax paid in the entire country last year.
5% from one company. It's just staggering. And how did they get there? He points to one key decision repeated over and over.
Reinvesting the earnings, almost religiously. He mentions they've paid only one cash dividend in 60 years.
1967. A tiny one he seems to regret now.
Yeah. So that massive tax bill isn't just some random number. It's the direct result of 60 years of compounding, of plowing profits back into the business instead of paying them out.
It's a powerful lesson for anyone, really. Even on a much smaller scale, compound growth is amazing.
And the total tax paid over the years. Over $101 billion. Cumulative.
Yo, wow. He had that analogy, too, to make the $26.8 billion figure more concrete.
Right. Imagine writing a $1 million check every 20 minutes around the clock for the entire leap year of 2024.
Nonstop.
And even after doing that, you'd still owe money at the end of the year. It's just an unbelievable amount.
Really drives home the scale and the power of that reinvestment strategy. Okay, so where does all that reinvested capital go? Let's talk strategy.
He calls their equity approach ambidextrous. Two hands, basically.
Yeah.
On one hand, they fully control businesses, own them outright, or at least 80%. He says there are 189 subsidiaries like that.
Yeah, that's one hand.
The other hand holds big chunks of publicly traded companies. Minority stakes, but significant ones. Apple, Amex, Coke, Moody's, those kinds of names. worth $272 billion at year-end.
And they don't inherently prefer one approach over the other.
Nope, they're impartial. It's all about where they think the capital can be deployed best in any given time. Sometimes opportunities are scarce, other times they're knee-deep in them, as he says.
But being so huge must create challenges, right? Especially with the public stocks.
Absolutely. He acknowledges they can't just jump in and out of massive positions without moving the market price. And with those minority stakes, they don't have direct control over management or how those companies allocate capital.
Whereas with the companies they own outright, they do have that control.
Exactly. Though he says they rarely sell those controlled businesses, only if they see unending problems. Some sellers apparently want Berkshire as a buyer because they know Berkshire tends to hold on and let good managers run things.
Interesting. So even with all the cash they hold sometimes, the bias is always towards owning businesses.
Definitely. He reassures shareholders. Most of the money is in equities, and that's not changing. They'd much rather own pieces of good businesses long-term than sit on piles of cash indefinitely.
And the reason for that is risk.
Yeah, the risk of holding paper money over the long haul. Fiscal policies can erode its value. But good businesses, run by smart people, can usually adapt to inflation or other monetary weirdness.
He sounds pretty confident in American business overall.
Extremely. He basically says his own success is tied entirely to the success of American enterprise. Admits he doesn't have unique talents himself. He sees sensible saving and investing as key to how society progresses.
Capitalism's got flaws, he admits, but America's track record is pretty remarkable.
And he ties it back to Berkshire's policy not paying dividends, reinvesting. Instead, he frames that as their way of participating in the American miracle.
That's a powerful framing. Okay, let's circle back to a core part of Berkshire. Insurance, specifically property casualty, or PC.
Right. He calls it the core of Berkshire Hathaway. Still fundamental. And the business model is, well, pretty unusual.
How so?
You get paid up front. Collect the premiums first. But the cost paying out claims might not happen for a long, long time.
Especially for things like asbestos claims, right? Those can take decades.
Exactly. Those are long-tail liabilities. And this gap between collecting premiums and paying claims creates the float.
Which is?
Basically, a huge pool of money that doesn't belong to Berkshire, but that they get to hold and invest for their own benefit, often for years. Think of it like an interest-free loan. It's been a massive engine for growth.
But there's a catch, isn't there? A risk in that model.
Oh, big time. An insurance company could be seriously underpricing its policies, losing money hand over fist, but it might not show up for ages because the claims haven't fully developed yet, especially in those long-tail lines.
So you could look profitable, but actually be digging a hole.
Precisely. He warns about that potential for misleading short-term profits. Berkshire's goal, historically, has been to roughly break even on the underwriting the insurance part and make money by investing the float. Maybe make a small underwriting profit.
And he mentions that losses seem to be getting bigger and less predictable now. Cites wildfires.
Yeah, the environment for losses is changing. That makes pricing correctly even more critical, and fighting claims that aren't fair or are inflated.
And Ajit Jain gets a lot of credit here, right?
Huge credit. Buffett says he transformed Berkshire's insurance operations into a world leader, known for taking on big risks others won't, backed by immense capital.
And he mentions that alignment of interest again, everyone having their own money in Berkshire stock, discourages foolish risks.
Right. Skin in the game. He also makes the point that the PC insurance industry basically grows because economic risks grow. More cars mean more accidents, more valuable property means more potential storm damage.
So risk creates the demand.
Exactly. And the industry adapts, like shifting from annual car insurance policies to 6-month ones to react faster to changing loss trends.
And Berkshire's advantage is its sheer size.
Size and financial strength. They can handle massive losses that would wipe out other insurers. They don't rely on reinsurance the way others do. But discipline is key, avoiding writing policies just for volume if the price isn't right.
So overall, still bullish on the insurance business.
Very, because of their financial capacity, their cost advantages, and the management team. He describes the mindset perfectly. Nervous, but not paralyzed. Aware of the risks, but ready to act.
And the track record speaks for itself. $32 billion in after-tax underwriting profit over 20 years. And float growing from $46 billion to $171 billion. Incredible.
Truly is. Now, speaking of investments, let's touch on something a bit different for Berkshire, their increased focus on Japan.
Right, that stood out. Usually it's very U.S.-centric.
Since 2019, they've been building stakes in 5 big Japanese trading houses. I2AC Chu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. He says they operate kind of like mini Berkshires themselves, with diverse holdings.
What drew them in? Just cheap stocks?
That was the initial hook, apparently. Low valuations.
Hmm.
But he says their admiration has grown significantly since then.
For what aspects?
Their capital discipline, management quality, and how they treat shareholders. Increasing dividends, sensible buybacks.
And he mentioned executive pay, too.
Yeah. Says it's generally less aggressive than in the U.S. Berkshire sees these as very long-term holdings, plans to support the boards.
They had an agreement about ownership percentage.
Initially, yeah, to stay under 10% in each. But that's been relaxed a bit, and he expects they'll own more over time.
Has it worked out so far?
Seems like it. Cost basis $13.8 billion, market value now $23.5 billion. Pretty good return.
And they're managing the currency risk.
Trying to. By borrowing money in Japanese yen at fixed rates. Kind of offsets the exposure of holding the yen-denominated stocks. Aims for currency neutrality, though GAAP accounting makes that look messy sometimes.
And the basic math works out. Dividends versus borrowing costs.
Right now, yes. Expected dividends are significantly higher than the interest they're paying on the yen debt. Seems like a smart strategic diversification.
Okay, wrapping things up, the letter always includes the invitation to the big event.
The annual meeting in Omaha, May 3rd, 2025 this time. Schedule's tweaked a little.
What are the highlights for anyone thinking of going?
Well, the main event is the Q&A, of course.
Yeah.
Buffett, Greg Abel, Ajit Jain taking questions for hours. And the shopping. All the Berkshire companies set up booths. Squishmallows, Fruit of the Loom, Brooks Running Shoes, you name it.
And there's a special book this year?
Just one book for sale. 60 Years of Berkshire Hathaway, a sequel to Poor Charlie's Almanac.
Oh, cool. Who put it together?
Carrie Sova, who used to help run the meeting. Buffett says she created this great lighthearted history with unpublished photos and stories about Charlie Munger. Sounds fantastic.
Probably hard to get, though.
Only 5,000 copies printed. So, yeah, likely a hot item. And Carrie wouldn't take any payment for it. Yeah, and get this. She and Buffett are co-signing 20 copies to donate to a local charity, the Stevens Center. Buffett's matching whatever donations they bring in.
That's wonderful. So, logistics for the meeting day.
Becky Quick from CNBC will be there covering it, doing interviews. No movie this year, interestingly. Starts earlier, 8 a.m., with Buffett's opening remarks, then straight into Q&A.
Who's on stage for the Q&A?
Buffett, Abel, and Jane start. Then after the mid-morning break, just Buffett and Abel, Becky alternates questions with the audience.
And it wraps up around lunchtime.
Meeting ends at 1 p.m., but the exhibits stay open till 4. And for the runners, the Brooks 5K is on Sunday morning.
Always a popular part. And he ended with that funny story about his sister.
Yeah, his sister Bertie, who's 91, she'll be there. And apparently she has a theory that using a cane is great for warding off unwanted attention.
He told people to watch her and see if it works.
Classic Buffett humor.
So, okay, we've covered a lot from this letter. If you had to boil down the key takeaways from this deep dive.
I'd say the transparency about mistakes, first off. The huge importance of great management, Pete Legal's story, really hits that home. The sheer scale shown by that tax number. The unwavering long-term investment view. Understanding the unique insurance engine, the float, and maybe this newer angle, the strategic move into Japan.
Yeah, those all feel central. It's always fascinating to get that direct download from Buffett on how he sees the world of business and investing.
Absolutely. Always valuable lessons in there.
Which kind of leads to a final thought for you, the listener. We've talked about long-term thinking, admitting mistakes, the power of reinvestment. Think about those principles. How could they apply in your own life, your work, your own investing, whatever scale that might be? You know, what's the American miracle, or just your miracle that you're building in your own way?
That's a great question to ponder. And hey, if this sparked your interest, definitely read the full letter. There's always more detail in there.
For sure. And maybe we'll even see you in Omaha next May.